Welcome to the new truth about real estate. It is our online event. I want to thank everyone, coast to coast, who registered for this event. We are expecting a little over 1,052 people. So that tells me that it's not just us that like to talk about real estate. You need to know more. You want to know more. And so we're not going to waste a lot of time. As much as I like the cameras on me and as much as I like the sound of my own voice, we have a jam-packed online event. I had the opportunity with my internal team to take a look at where people are coming in from today. And when I say we have someone being represented from every single province in the country, I'm telling you right now, people are very hungry to know what is the truth about real estate? What is happening currently in the real estate market, not only in the major cities in the country, but right across our beautiful, beautiful nation. And so I wanted to make sure that I brought in not only some people that love real estate, breathe real estate, sleep real estate, but they're going to be giving you a macro picture of what's happening in the market, what we saw in 2025. And for some people, it's not going to be pretty. That's why we call this event the new truth about real estate. We're not going to be going into a lot of headlines because I think it's more important. Hence why our second guest is going to be going into what's actually happening on the ground. So wherever you are in this beautiful morning, right across the country, and I'm at our head office here in Toronto, Canada, and the flurries are coming down. Hopefully you got a coffee, warm, sit back. We are going to be very prompt today, and we're going to be stopping exactly at 12 p.m. Eastern. But before we get started, I would be remiss if I didn't thank a couple of teams that made this whole event happen. You know, behind the scenes, to have a little over 1,050 people registered, a lot of people need to collaborate. And so first and foremost, I want to thank the team at REIN, the biggest real estate investment network in the world. I want to thank the team for putting out this event in partnership with my team at REC Canada. As well, we have guests from Royal LePage Signature, as well as from the Ground Up Academy. We have our friends and family from our socials, my business partner, who you'll be hearing from today. Call him the beautiful Greek, Mr. Simeon Papailias. You'll be hearing from him later. Our friends and family. We do have the Q&A open. Now, what I ask of you in the Q&A, because when we speak about real estate, the numbers are very important. But I do know, because we've been putting on events like this for over two decades now, that your questions are personal at times. And so do us a favor. If you have a question, try to make it as general as possible so we can get to it in the later part of our online event that we are, as I mentioned, we're going to go very, very quick for the next 90 minutes. In fact, I want to bring on our guest speaker today. And generally, I can go off and just tell you about somebody just off the top of my dome. I got a fresh haircut today, too, for this event, so it's shiny as well. But this gentleman is up to so many things. He's done so many things. And I asked him, I was like, can you do me a favor? I don't want to butcher this. Give me your bio. Let me read it, because it's so, you've done so many things. And so our guest speaker today is going to be Patrick Francey. He's a seasoned entrepreneur, visionary thought leader, and transformational coach with over 40 years of business ownership and experience. He's the CEO of the world's largest real estate investment network, REIN, an advisor for McKay CEO Forums, and the creator of Mind Shui, described as Feng Shui for the mind, which I just love. He's the host of 2 top-ranked podcasts, The Everyday Millionaire and Mindset Matters. We're alongside his wife, Stephanie Hanlon Francey, a world-renowned 4-time, let me just say that again, because that's really cool. And it is obviously his better half. 4-time Olympic and award-winning mental performance coach. They lead conversations and programs that help individuals elevate their thinking, break through internal limitations, and live with greater purpose. His work is grounded in helping high performers clear mental clutter, realign with their truth, and design a life of intention across all 7 areas of life: mental, physical, emotional, spiritual, financial, relational, and vocational. Patrick brings a rare blend, and you guys are in for such a treat today, of grounded business wisdom, transformational insight, and decades of leadership experience. Don't let the decades fool you. With coaching CEOs, real estate investors, leading immersive retreats, on speaking on stages or podcasts, his mission is clear: to empower others to live life by design, not default. My friend, Patrick Francey, how are you doing today?
Fantastic. After that introduction, that's so great. I didn't write that bio, but hey, I sound pretty good anyways. I hope I can deliver.
Jas is giving boxing announcements.
And weighing in at, no.
Exactly.
Patrick, there's going to be some people here out of the little over 1,000 people that are going to be joining us today that do know you. But as I was saying to you, as we were talking, in the last couple of days, I'm so excited for you because a lot of my network, a lot of Simeon's network, our friends, our family, past clients, they don't know you. And that's going to be so cool for them to, hear you for the first time. And for everyone who's watching this webinar right now, my boy Patrick's in BC. And so it's 7:30 in the morning today, but him and I were actually talking, I think about a couple of hours ago, and he goes, Jas, I'm stoked. I know it's 5 o'clock in the morning where I am, 8 o'clock where you are. And so, Patrick, I don't want to take up too much more time introducing you. I just want to give you the stage. We'll be back shortly, myself and Simeon. Guys, you guys are in for a treat. Take a lot of notes. A lot of notes. Dial in, lock in. If you can. I know we have kids running around on a Saturday morning. I know we have family members, but if you can lock in for the next 90 minutes, I guarantee you, I'll give you the money back for what you paid for this event. Side note, I think it was free for everyone. I guarantee you.
You're so generous.
Yeah, I know.
Always that big pocket of yours.
It must be the holidays, Simeon. It must be the holidays. Merry Christmas to everybody. Happy Festivus for the rest of us. Patrick, please take the stage and do your thing, my friend.
Awesome. You're so generous. You're like me. I like to always, when we go for dinner with friends, I always buy the first round of water. And,
right.
I'm really good at that. So let me share my screen. Give me a second to get my technology lined up here, and we'll get to work. I got a lot of ground to cover. I am very excited. And so there we go. I did have issues this morning. I think I got them resolved. At least I hope I do. So everybody can see my screen, I'm assuming, Jas?
Yeah.
All good.
Hey, beautiful. It's a beautiful thing. Okay. So, in my intro, before I get started, context is so important. And, I have been in business for over 40 years. I've been through a number of downturns, literally, I think 4, maybe even 5 recessions, a number of downturns. So, what we're facing and what we're going through today, I've been through it. And I want to share with you today some different ways of looking at what is happening in the world, what is happening in your world, perhaps, and then give you some tools to work with it. There is that phrase, give a man a fish and you feed him for a day, teach a man to fish and you feed him for a lifetime. And my goal literally is today is to give you a way of looking at what's coming and to prepare you so that you have the tools, so that you can look at what's happening in the world today, the headlines that we all get inundated with, social media, Twitter, wherever you might hang out, but to actually look at this information and take the emotion out of it. I cannot stress that enough. The most difficult thing in the world of investing, in the world of what we're going through right now economically, is not being emotional. It's like it's hard to not do that. So what I want to get you today is grounded in and give you a place to go where you're actually looking at the data. You know, there is an economic storm on the horizon, as they say. You know, some people are, you know, already in it. We know it's coming, or at least if you're paying attention and you have some idea, you know it's coming and you know you're in it, or others are in it. We don't know when it's going to hit. We don't know how hard it's going to hit or how long it's going to last. But I want to share a bit of a story with you. You know, there is on the prairies in Alberta, Saskatchewan, there's an old story that goes around about the difference between cows and buffalo. And you may be saying, Patrick, what has this got to do with us? You know, here's the thing, is that they noted that when there's a storm coming, cows start to move away from the storm. They actually, as it hits, they run away. Buffalo, on the other hand, they run into the storm. They lean into the storm. The goal being in that thought process is they want to get through and to the other side of the storm quicker, more efficiently, easier. Whereas the cattle run away from it, but eventually they get hit by the storm. They've got nowhere else to run and they're not prepared. So there's a little bit of an analogy there that I want to give you, is that our job, literally as investors, is not to run away from the storm. We need to lean into it because there is the opportunities that this is going to create. You know, what if you could see the future? And my job today and my goal today is to equip you to see the future. There is a bit of a crystal ball. Now, there is, obviously we don't see the future. We have to look at it as investors and we consider possibilities and then we consider probabilities. And when we look at the world through an eye of what's the possibilities, what the probabilities, we start to make different decisions. But we have to look at the data to do that. You know, I use a phrase that Stephanie and I adopted a long time ago, which is clarity equals velocity. I would add that to that now, which is clarity equals velocity, but it also equals courage. Because when you have clarity, you have courage, you have the confidence to move forward. Because here's the thing, confusion creates chaos. And we are in a very confusing world. But what we do know, and what I can share with you as a business owner, as a real estate investor, for more than 40 years of being in the world of business, understanding that the fear, the uncertainty, and the doubt, the FUD, is frightening, but it is also where opportunities live. And we need to step back and recontextualize what we're going through right now. Our job is to get rid of the emotion and make data-driven decisions. Now, those are all great words, easier said than done. But in the context of understanding this, you will, I hope, look at the headlines that you're getting hit with, the social media, the rhetoric, the vitriol, through a different set of eyes to give you the confidence and the clarity to move forward, to kind of step back from the emotion of it. Now, I wanted to give you that context as we go through the rest of the deck. Now, I'm going to give you lots of data, and there's going to be lots of charts, and given our time frame, I have to move at a pretty good space. But the good news is this. Don't spend a lot of time worrying about taking pictures or clipping or anything of the slides. Jas and I have talked about it, and Simeon, and you're going to get this deck as you reach out to them, and they'll get you connected. So understand that we go through different cycles of real estate. You know, in this case, you go through a boom, a slump, and a recovery. We're all familiar with boom cycles. And if you've been on the planet a while, you've been in the game, we're also familiar with slump cycles. There's a phrase that I use, you know, boom cycles hide a lot of real estate investors' mistakes. And sadly, slump cycles are when they pay for those mistakes. And when we're in the boom cycles, we love it, don't we? It's all, you know, lots of energy. Everybody's jiving and doing deals. And man, oh man, everybody's getting rich. And it's so awesome. But then we go through the next phase of that cycle. The economy changes, the economic fundamentals changes, the influencers change, and we go into a slump cycle. Now, we're all familiar with the boom cycle because, you know, we're all geniuses in a boom cycle, aren't we? then we get hit with the slump cycle. And, you know, for those who don't pay attention, for those who are thinking the boom cycle is going to last forever, they're not prepared for the slump cycle. Many got caught. Many get caught in the slump cycle. Now, you know, I've spent a lot of years investing, and, you know, I started investing in real estate about 25 years ago. So it is because I look at the data through the set of eyes and the data that I'm going to share with you today, more the methodology, is I got through, you know, my partners and I got through millions of dollars worth of real estate in Alberta in 2008, 2009, when we went through that slump cycle. Again in Alberta in 2014, when we got hammered again with, you know, what was going on in the oil and gas industry. The thing is that we see these things coming. We can see the future when we look at the data. It tells us everything. But if you don't know how to look at the data, and there's lots of talking heads out there that they're trashing the, you know, what's going on. And I can get very political, by the way. I make no apologies for that. I'll try not to get political today. But we have to look at the cause of this, and then also understand that the cause is, you know, creates an effect, and we want to be aware of it. So when we go through these cycles, you know, boom, slump, or recovery, and of course, in most regions, I'm going to say most regions in Canada, we are in fact in a slump cycle. By the way, Alberta is entering a slump cycle. So for those of you from Alberta, I've shared many times, you know, what's going on in Calgary, we were talking about 3 years ago. I'm giving people a heads up in Edmonton, going, Edmonton, you guys are in, you know, you're coming out of your boom cycle. You better be paying attention, because you're going to go into a slump cycle. Now, having said that, not all slump cycles are created equal. And will they feel some discomfort in Alberta? 100%. Is it going to be as bad as Ontario or BC? No, I don't think so. And there's lots of reasons for that. So for those of you who are really interested in understanding this, you know, the book Secrets of the Canadian Real Estate Cycle, written by Don R. Campbell and Kieran Traz, I think back in about 2008 or 2009. This book is still relevant. I would encourage you to read it if you're interested in these things, so you understand the cycles and you can start to prepare for them, so you can start to see them. The thing is that I often say there is no bad time to invest in real estate. There's only the wrong strategy given what's going on economically. So it's critical that we understand that part of it, because many are saying, well, you know, right now investing in real estate is just stupid. Well, I'm going to argue that point. I'm going to go, no, there are strategies that work exceptionally well in this particular economy. So, you know, don't worry about this chart. Again, you're going to get this presentation, but understand that this is not the time to run and hide. This is the time to lean into the chaos so that you can prepare for the opportunities, see the opportunities, create the opportunities. And part of that is going to be by solving problems. Now, the long-term real estate success formula, we have taught this for years. This is absolutely foundational. We've put it into a context that I think most people can understand, because when we look at what's going on, we realize that real estate is at the effect of what's going on economically. Pretty common sense, isn't it? But there are economic drivers. They're called economic fundamentals that we have to pay attention to. This is critical. So when we look at what's going on economically, we understand that GDP growth, we all hear about it, you know, GDP, gross domestic product. You know, I give it a quick, for those of you who say, well, I don't really understand it. It's, you know, I look at it this way. The GDP growth, the number that they give us, is an economic snapshot of the health of a region, of a country, of a province, of a city. When you have GDP growth, what it does is it means that you've got employment growth. It means that you've got population growth. The reason being is that when you have GDP growth in a positive way, it means that people are working. And when you have people working, you're also creating jobs, and people are moving into that city, into that province, into that country. And we certainly know a lot about the immigration in Canada and what's been going on. I'll talk about that shortly. But when you have positive GDP growth, you start to see that in about 18 months, 2 years, 12 to 2 years, depending on what's going on, you start to see real estate shift. You get increased rental demand, you get decreased vacancy or decreased vacancies, and you get increased rents. We've all been through that. We saw that happening. We literally lived through that just recently. And then as people get adjusted and as immigrants come into the country, and as people get kind of established in whatever city they move into, whatever the neighborhood they move into, they start to, number one, immigrants coming into the country, the first thing they do is rent. And you know they're going to rent because they don't have enough money. They don't have a credit rating. They may not have a job. They have to get established. Culturally, they don't know where they want to live. So they rent. And about, like I say, 18 months to 2 years later, they start to move into the area called I want to own property. And so you start to see property prices rise. Now, what I just shared with you, you should relate to extremely well because we've just been through that whole process in many parts of Canada, at one point, all parts of Canada. And then besides the fundamentals, there are the influencers. Now, the influencers are usually shorter term. It doesn't mean short term, but we go through a shorter cycle generally with influencers. Well, what is an influencer? Well, we know the economic fundamentals that drive real estate and the economy, but then there's the influencers. Interest rates. Yeah, we're all pretty familiar with the interest rates and the influence they have on it. Then there is, COVID is an example of that. What went down through the pandemic and the lockdowns, and man, but it was short term. We're kind of through it, but we're certainly still at the effect of it. I would say that, 2020 was the line of demarcation, and ultimately our world has changed forever. And I think we need to just understand that, embrace it, lean into it again. And of course, politics, huge influencers. We've never been more at the effect of government, and I won't go off on too many tangents around that. Well, the other reality that we're now facing is when the opposite of that happens, we go into a different cycle. We go into what we'll call a slump, where we start to see GDP go down. We start to see growing unemployment. We start to see a decline in population. Now, arguably in Canada, some would say, well, we don't have a decline. We got too many immigrants coming into this country. That's what's created the problem. But the reality of it is they've turned off the tap in a lot of areas. More on that shortly. So then what do we see? Well, when you've got a slowing economy, when you've got increasing unemployment, so people aren't working, you start to see a decrease in rental demand. And then, of course, ultimately, you see an increase in vacancies. And then what happens? You see decreased rents. Why is that? Well, ultimately, it's because, vacancies go up. Landlords have to react. They, start doing free months rent. They start bringing the rents down. They need to get competitive. They need to drive people into it. And then what do you see? You see an oversupply of property in some property types. Again, I stepped over that. We always need to understand that real estate, number one, is regional, very regional. And secondly, is that property types matter, and more on that in a little bit, but we have to understand that. So when we start to see that decrease in all of this, we also start to see the real estate market shift on the sales side of it. We see decreased property values because demand is decreasing, especially in particular areas. Now, the difference with the world today that started back in 2007, 2008, is that we are now in a world of very quickly devaluing dollars. And so hard assets are no longer an option in my world. If you want to sustain wealth and create wealth, if you want to keep up with what's going on, this is about survival as we start to see our dollars melt away. They are devaluing. We feel poorer because our dollars are buying far less. Our wages aren't keeping up with it. So I want to get into a lot more of the detail of the data. And this is where, I'm going to encourage you to keep notes in terms of how you want to view the data that comes at you, how you want to see the headlines, what you want to research perhaps. The game of building wealth has in fact change, digitization, AI technology, wars, global politics. I mean, it's never been greater and grander. Arguably, for those who pay attention, we are on the verge of World War III. Whether we get there or not, what does that even look like? We don't know. But also the societal and the political division has never been greater. And so we look into it, and, I'm going to say that there's no good news in anything that's happening right now if if you just look at what's going on economically. I'm not going to put on rose-colored glasses. I'm not going to try and sugarcoat anything what's going on in the world today, because it is kind of like, holy cow, how do we prepare for this mess? Some of you are feeling it, others maybe not so much. But we understand that the monetary policies are changing. We understand that our dollars are buying less. This is a global shift that is happening in the world. This isn't just Canada, it's every country is dealing with the same issues. And that is the money printing that went on. We are record debt, record deficits. Monetary policy is changing. We've got QE, we got quantitative easing. We've got, then we had, before that, we had some quantitative tightening in between all of that. But we are going back to the printers. We're going to start to see that happen a lot in 2026, both US, Canada, Japan. I mean, gosh, if you're following Japan. Interest rates, I got to say that I think, we saw bond yields boom yesterday. And we're going to start to see fixed rates go up. So, some of you who are kind of maybe on that edge, lock in sooner than later, maybe. I think you have to really look at it. At the end of the day, institutions are preparing for a storm, and they're preparing differently than they've ever prepared before. And for those of you who may be precious metals or gold bugs, as they say, others are not even paying attention, I'm going to encourage you to look at some of the things that are happening in the world, because this does affect our economy, it affects our businesses, and it certainly affects our real estate. So this isn't to frighten you. This isn't to be all doom and gloom. And this is just what it is. The market is what it is. So I'm trying to guide you and give you some different ways to look at the world so that it isn't all doom and gloom, so that you see the opportunity, so that you can, in fact, prepare. That is my goal. So when we start to understand monetary policy, we look at what's happening in the gold market. We look at what's happening in the precious metals market. So you start to see that, back in, gold price, this happened to be June 2003, just an arbitrary date, $481.47 an ounce Canadian. Looking at it today, we're bumping $6,000, $5,800. And you go, well, Patrick, what has gold got to do with anything? Here's the thing. Gold for for 5,000 years has been considered real money. And what's happening is central banks around the world are loading up with gold. Canada, however, we got no gold. You probably got more on your necklace. So the point of it is that this is a run to safety. What does it mean? It means central banks are loading up on gold by the ton. Record gold, record silver. Again, now silver has, two plays. And number one, it's monetary. Secondly, silver is needed in everything that we're doing. And as a matter of fact, the demand for silver is going to go through the roof. Now, I started talking about precious metals. I started sharing it. I myself started investing in precious metals back in 2008 through the great financial crisis, because we could see things coming. Now, I share that with you only because looking at the economic fundamentals, this works. We look into the future. We see it coming. Did I go, wow, did I make the right decision investing in precious metals? And I don't actually consider it an investment. It's insurance. Because when I saw what was happening with the money printing in the great financial crisis back in 2008, we saw that meltdown. The US felt it far more than Canada, but ultimately we had to get into and shift how we held money. So for me, I'm not investing in precious metals, and I'm not suggesting you do. I'm giving you context again. All I was doing was exchanging one form of money, gold and silver, or fiat currency, our paper money, for another form of currency, because I knew that our fiat currency would get watered down. And, just to give it some validation, if you will, this is what is China, the question is, what is China preparing for? This is China's gold stock levels. This is China. Now, of course, what's happening with China is that they are in an economic competition with the US. Now, I'm not going to get into that too much, but I wanted to give you an understanding that hard assets are what protect us from the devaluation of our dollars. We're experiencing it. We're seeing it firsthand, and we may be not recognizing it, but I want to give you that information. Okay, We're going to connect the economic dots. That's the game we play as investors. That's the game we play as business owners. We have to look at our GDP. March 24, Bank of Canada Senior Deputy Governor Carolyn Rogers. I love her. I think she's an absolute rock star. I think she should be taking Tiff Macklem's job, but that's another conversation. But she noted that productivity has declined significantly in Canada. So she actually said, we've seen the signs, you've seen the signs, and that say in emergency, break glass. Well, it's time to break the glass, Canada. That was her statement. And it's so true when we start to look at what's going on. Canada's GDP, and this is, I'm going to risk getting a little political here, but when we go back to 2015, when we shifted our politics, when we actually elected this particular government, that values have changed, by the way, we start to understand how flatlined Canada is. We are not productive. So I'm going to preface this. If you're making notes, the majority of our economy has been driven up until now by two things. One is real estate. We're all familiar with that. Secondly is consumerism, driven by record-breaking, face-ripping immigration. Immigrants coming into a country consume. They set up house, they buy furniture, they buy clothes, they get themselves set up. And consumerism feels really good because there's a lot of money flowing through the system. Increased capital investments, however, were driven by government capital spending. So we live in this illusion that the economy is going good, but when we lift the hood is when we start to see what's really going on. And the government capital spending 2.9%, supported by a substantial 82% rise in expenditures on weapon system. So we see back here, last month we were underwater 0.5. This 1.6%, majority of it is government spending. So we think, and the illusion and the rhetoric and the headlines are, wow, look at what this government has done. Well, they haven't. Again, I'm going to get politics aside. It just is what it is. I can get fired up about politics, but I have to look at the market and make decisions based on what is happening. What can I control? And what I can control is the decisions I make. And the decisions I make, I want to base them on how I see the future unfolding because I'm looking at the data. I'm connecting the dots of looking forward. Canada federal budget deficit as a percentage of GDP. We're underwater. Now, I can't stress this enough. When we look at that, we go, well, what the heck does that mean? Well, we have to understand that deficits are what's creating one of the problems that is being created. It means we have to increase taxes. We have to keep the country running. So we're operating in deficits, and we are going to see continued raising taxes because we're not building business at this point. Canada's labor productivity continues to fall. We go back to, the early years where look at where our productivity was over here versus where it was back in 2023. And by the way, it's getting lower, far lower. It's flatlined, as we can see. And then on top of it, we verify that data and we look at what's happening. Canada's GDP at basic prices by industry, and we look here, all these jobs up here, the majority of these jobs are non-productive jobs. They are service jobs which are productive, don't get me wrong, but they're not manufacturing, they're not producing a good. They're bureaucracy, they're administration. And when we look at the industries of, for example, mining, agriculture, wholesale, manufacturing, they're all down significantly, which means our GDP is dropping. So GDP growth and small business sentiment. Here's the fundamental challenge, folks, is that capitalism works. A lot of people, especially in the world where we seem to be shifting towards socialism as young people are struggling, it just is way more appealing. And I'm going to not go down that path. I'm just giving you context. What we start to see happen is small business sentiment. So think about here. So this blue line is real GDP growth. And this is the Canadian Federation of Independent Business Barometer. When GDP is where it needs to be and positive, you start to see that business rock and roll, right? We see it a little bit hiccuping here, and then boom into what's happening with the GDP. So GDP drops and small business runs into problems because they don't get optimistic. They're hit by a downturn in consumerism. They're not buying inventory. So in other words, the economy continues to slow down. So we have to create jobs, and private sectors build productivity. They actually drive an economy. Governments cannot sustain an economy, and we need to create jobs. So when we start to look at what's happening across the country, we see increasing unemployment. Now, I'm going to give, there's an interesting context here I'm going to give for Alberta, because you start to see, well, if Alberta's so great, why is unemployment so high? Well, the reality of what's happening in Alberta is you've got so many people moving into the province that it's, I use the example, if I take my coffee cup and I pour a bunch of coffee into it, at some point, if I don't stop, it overflows. And what's happening in Alberta right now is there's so many people moving into that province, there's a lag of jobs to catch up. In other words, there's just not enough jobs to go around. Although that is shifting, the employment levels are shifting while the unemployment remains high, but economically they stay pretty strong. Now, I have businesses in Alberta, right? So for many years, and when I look at my retail business, I'm in a kind of a very specialty high-end boutique, and those with money are still spending it, although reluctantly. We can talk about that as well. So the public sector share of total employment, back here we start to say, well, we need to create jobs and we need to have productivity. But the problem that we face is a majority of jobs, and I say majority, have been public sector. Now, I don't have a problem with public sector, but we're not actually driving jobs in the public sector. I'm going to say, health services in some regards, police, RCMP, some provinces really need that. But a lot of this is just bureaucracy. And sadly, bureaucracy just chokes us down. When we look at the number of firms that are employing, all of a sudden we start to see that firms with 500 or more employees are growing, where firms with less than 500 are actually shrinking. And it is the SMEs, the small and medium enterprises, that are responsible for driving the majority of the economy. Yes, big business is great and billions of dollars and a few thousand employees. That's all very, very good. But you need a secondary cohort, if you will, or world called small SME businesses, because they hire people, they spend money, they drive an economy. Now, I give a couple of examples here, and just to give you some idea, this happened to be a chart by the Alberta Treasury Branch, ATB Economics, and we start to see the monthly unemployment rate in Alberta versus Canada, and you can start to see it kind of follows the plot and is in fact coming down to match what's going on. So this is to say that unemployment is regional. And I want to go back to this slide just so I don't step over it. And that is when we look at what's going on in Ontario, 7.6%. When we look at Toronto proper, it's almost hitting 10%. So again, very regional understanding. So for you as an investor, when you're looking at what regions you might want to consider, or if you're looking at the region that you're in and you want to know where things are going, you have to look regionally and break down the data. Now, I can't possibly do all of that in this particular presentation. I mean, I do these every single month within the REIN community, but we have to consider the economic data is always shifting and changing. So when we look at labor force indicators, you start to see population. And I'm only shining a light on Alberta in that it is a very positive economic picture relative to what's going on in Canada, Saskatchewan, Manitoba. Saskatchewan, Manitoba are great, by the way, much smaller populations. You're looking at 1.2, 1.3 million for an entire province, but they're doing economically very, very well. So you start to see Alberta, when you look at the labor force and the population growth in Alberta versus the rest of the country, or the labor force in Alberta versus the rest of the country, and employment. Employment is, jobs that are there is much stronger than we look at the overall country of unemployment. So employment is something that we want to pay attention to, because the employment numbers in any province, if they're going up, are far better. Annual change in private sector payroll, you start to see it's down. Again, I'm going to hit on what Carolyn Rogers said. We're losing productivity. Now, when you've got the two primary drivers, or two big drivers of our economy, being real estate and consumerism, what happens when those things slow down? Well, we're feeling the effects of that. And we're feeling the effects of an economy that wasn't built on productivity, manufacturing as one example of that. So income versus income tax growth, what we know in Canada is we're getting taxed, we're getting hammered. And so as much as we pay whatever we pay on our income tax, then of course there's GST, and there's every time we turn around, we're being taxed on something in some way. So we have to consider, and hidden tax, we always talk about, photo radar. I mean, it's just another tax, they'll justify it, but it's actually just another way to raise money. And many cities across the country have raised many, many hundreds of $1 million by just having photo radar for whatever reasons, whether it's speeding or stop signs or stop lights or whatever it might be. So Canadian property taxes surged. Now, we started talking about this actually back in 2020. Well, how did we see the future? Because we knew that ultimately, as things start to shift economically, and you start to see, for now, here's a classic example. Condo market in Toronto melted down. Developers going broke. Not building, stop building. So think about how many millions, billions of dollars Toronto proper raised just in development fees, just in zoning costs, just in the taxes that got paid, let alone the transfer taxes and all that goes with that. So it was pretty easy to see this coming early on, because we could start to literally see how this was going to unfold earlier. So those who follow us, kind of understand the thought process that we have here. But of course, property taxes are going to go up, and they're going to surge some more. And the reason being is that all of the rest of the development charges, as an example, the municipalities can't raise money. Businesses pulled out of some of the cores, and as much as they're going back, they're downsizing. Taxes are getting less and less. Our Canadian federal budget deficit as a percentage of GDP, I showed you this earlier, but Jason Jas, parliamentary budget officer, for those of you who followed this and heard this conversation, he absolutely annihilated this budget. He annihilated this government. He called them on their shortcomings in a very, very professional way. They denied it, of course. But, when we look at the fact that we have this federal budget deficit as a percentage of GDP, we start to understand the impact it's going to have. Healthy debt to GDP ratio, stable or declining over time. We've entered new territory. As government argues, we have room to spend compared to other countries. Understand what he is repeating here. His conversation with finance minister or Carney is, Carney actually said, we have room to spend compared to other countries. That's how they're justifying it. Who cares about other countries? We got our country. The point is this: they're going to spend more money. They are going to have to print more money in different ways, monetary policy, and it won't show up that way. There's not going to be a headline, more printing money, but they are literally already doing it. They're doing it different ways, and I won't get into that today. It'll take too long. The point is what do we know when they start printing money? Inflation is going to hit. That's the bottom line. So the translation of what he said is more debt, more deficit, higher interest payments. That's what's going to happen because they're borrowing more money, more quantitative easy to pay the bills. That's how that works. And more devaluation of our dollars. That's just what we're facing. So these are things that we want to consider and understand. Again, nothing is exciting or it's not good news. There's just no denying it. So then we have to look at population growth. Now, as investors, we rode the wave of population growth. High rental demand, high real estate demand, drove prices, drove asset prices. That has shifted. That has changed because our population growth is shifting, but it's very regional. Again, we look at what's happening in Alberta versus Ontario versus BC. I want to say in October, I think it was September or October, Ontario, for the first time, had a net zero or a slight decline in population growth. A lot of people, in fact, are leaving Ontario. You still have positive growth, by the way, but when you look at what's happening, a lot of people are leaving Ontario. Why? Well, the cost of living is so high. The difficulty in getting a job is so high. So they are moving, and ultimately, Alberta is a province that is taking that interprovincial migration, one province to another. Population growth, here's an example in British Columbia. Boom, you see it coming off the rails. Ultimately, people are leaving and or not coming to the province simply because of affordability. That is our new reality. And as investors, of savvy business owners, we have to prepare for it. There's no point in denying it. There's no point in trying to run away from it. I'm going to encourage you to lean into it and hit this storm and come out the other side faster and in better shape. International study permits are going to fall by half. They have started to fall already. And for those who jumped on the wagon called student housing, they're now starting to experience the fallout of what's happening. I just had a meeting yesterday, day before, with somebody who's in the university here in British Columbia, and they used to, have these annual Christmas parties because they were so well funded. Now, this year, potluck. Bring your own food. We'll get together. We'll kind of go at the gym. We're not going anywhere fancy, because those universities where their coffers were running over with all of the students coming in, that game has changed. Investors who weren't prepared, who didn't see this coming, and again, I'm sharing with you what we talked about years ago, not to say how great we are. That please don't hear it that way. It's only to validate that looking at the data works. Understanding what's going on economically makes sense. We were literally within the REIN community telling our community, screaming from the frickin' rooftops, manage your student housing carefully. And as a matter of fact, consider shifting a bunch of your portfolio out of student housing, because they've already told us they're going to cut back. So non-permanent residents as a percentage of total Canadian population, we're starting to see that come down. They want to get non-permanent resident cohorts back to 5% of the population. Now, in classic government form, if you take that headline for what it says, or for that statement that the government says, you go, okay, well, we know that demand is going to come down because non-permanent residents are, in fact, our renters. Now, on the other side of that coin, however, they shifted how they see asylum seekers. So a lot of non-permanent residents all of a sudden became asylum seekers. And the visa system has changed, and who they're letting in the country and how they're letting them in the country. So has immigration been shifted? Yes. Has it declined quite a lot? Yes. But there's workarounds that are happening in the system, but be prepared for the fact that we're starting to see population growth decline. And what that means to us is that we are going to see softer rents. We are going to see longer vacancy times, and we're going to see rising vacancy rates. Now, depending on where you are, it's really, you're seeing it a lot, perhaps, you look at Toronto proper, for example, versus what's happening in Peterborough, versus what's happening in Hamilton, versus what's happening in Edmonton, versus what's happening in Regina. All different regions, all different challenges, and some are not as bad as others. Certainly, Ontario, Southern Ontario, is feeling the worst of the storm right now. That's not to say others aren't going to feel it. They are. Now, when we look at what's going on in the world, we have to start to think about the inflation that is hitting us. We're all feeling it, and it's hitting different cohorts. When you look in that bottom 50% earning right now, it's painful. It's having difficulties paying the bills. As a matter of fact, we're seeing credit card debt go to its highest level, and it's not because people are frivolously spending their money there's still always that going on, but it's actually being able to pay the bills to get through the month. And that is an indication of what's happening because wages are not keeping up. We talk about the CPI, or what many refer to as the CP lie. We look at the inflation numbers and we're going, what the hell are you talking about? And so they changed the basket of goods, how they look at CPI. The consumer price index has always been a benchmark, but we start to understand and learn more and more about how much it's manipulated. I'll give you an example. Was an awakening I was given many years ago. When they look at this basket of goods, they put beef in that basket of goods. And they actually literally have steak in that basket of goods, and they're saying, okay, well, steak only went up this much. Well, as it starts to rise, they go, oh, well, hold it. It's expensive, yes, but hamburger's still beef and it's cheaper. So all of a sudden they take that basket, instead of steak, they put burger and say, well, no, steak went up $27, but hamburger did not. So these are the games that get played. We start to understand that consumers still expect high inflation. We literally do. And we start to see what the target rate is, from the Bank of Canada versus what people are seeing and feeling. And we're well above that target rate, although they've shifted the target. We hear, well, we want to stay in that 2% range. And what we already know, that the 2% has been up to, well, we could probably live with 3%. We can't actually keep it at 2%. Conditions have changed it. We look at 2%, 2.5%, 3%. I'll give you a different way of looking at what the CPI is all about. It's not so much about the cost of goods, it's the speed of which prices are increasing. It's more of a speedometer than it is an indicator of what prices are. It's kind of a confusing kind of number that we use, just to give you another level of it. It is the speed at which things are rising. Because when we look at the actual numbers, we start to see, coffee, 76%, beef, 59%, when we go down, mortgage interest. So the cost of living is just going through the roof. This should say to you, holy cow, how do I stay ahead of that cost of living? How do I, let alone create wealth? How do I maintain and sustain the wealth that we have? How do I keep up with what's going on? Canada's 2.2% inflation. The real story is 4.3%. We start to look at our food, our shelter, our insurance. They're all going up significantly more. 2.2% inflation is the speed. The real story is 4.3%. Now, this particular one is October year over year. So you start to understand just how dramatically these changes are going through. So core inflation is really what the Bank of Canada looks at. And that's where they up the bar. They say they wanted at 2%. A couple of months ago, they actually shifted it. And they shifted it to say, well, we maybe need 3% because it's more realistic. Small business confidence. So what does this mean to us? As confidence shifts, we start to see that small businesses touch the brake. They don't buy inventory. They don't hire. They don't renovate. They don't buy new equipment. They're afraid of what's going on. So when their confidence slips, everything else slips. Canada's consumer confidence is down on the decline because we're afraid of what's happening. People quit spending money. Well, in a country and in an economy that's driven by consumerism, this has an impact on us. This number alone, this is something I look at all of the time. I look at it every month. I watch it. It varies up and down a little bit in moments in time, but ultimately consumers are not feeling good. Growth in average real hourly earnings, probably many of you understand this. Salaried employees, hourly employees, we're not seeing huge growth in our salaries, certainly not to the degree that it can keep up with inflation. Again, we look regionally across the country. Depending on what province you're in, you look at Ontario at 0.5%, where you look at a healthier economy at 1.2, or Saskatchewan at 1.4. So you start to understand that all of these things are regional. And when we look at real estate, where we want to invest, where we don't want to invest, we have to consider that the region that we're in, we want to look at these numbers. Again, index of consumer confidence, way low. And this really gives us a picture, I think, dramatic picture of just where things have come to versus where things were. And even when you come out of 2020, when it was low, way at the bottom, and then it spiked up, these were pretty great times, weren't they? 21, 22, 23, things were pretty great. We were in a boom cycle. Everybody's a genius and the confidence is high. And then reality sets in. Things catch up to us. Okay, Canadian real estate inventory hits a new record high. You know, you're surrounded by realtors, or you are a realtor. You understand this number. Inventory is off the charts. Having said that, a lot of it is being driven by the condo market. You know, vacancy rates are increasing. You start to see, we talked about this in Calgary. Again, gosh, had to be a couple of years ago, we were saying, you know, start to prepare. Edmonton is starting to rise, and as we go across. Now, I don't know, these, you know, the problem with average anything is that there is no average Canadian anything. These are very regional. They're specifically even in neighborhoods. So when you break down average rents, it's just an indicator, right? Change in apartment asking rents, no surprise, things are getting soft, and they're going to continue to probably get a little bit softer yet. So just in that regard. So what does that mean as investors? Number one, we got to be aggressive with our rents. Number two, we got to maintain our properties. We got to be competitive. We treat our real estate investing like a business. So as much as it's painful, you may need to upgrade. You need to paint. You need to maintain. You need to be appealing because people have options and they're going to shop. You know, here's where things get interesting, because as much as we're buried in Ontario and Toronto proper, GTA, in the condo world, there's some things going on. And we look at resale surprise strong now, but might prove fleeting. Construction activity for single family homes and condos has slowed. So we look at the condo market and we know that in probably 3 or 4 years, there's going to be a huge shortage because they've quit building. Can't justify it, can't make it work, so they quit building. A lot of those are going into the rental market. But looking at single family, they're not being built. Now, we've talked about this within the REIN community for so long. We are looking at this going, oh man, single family. What does single family mean? Okay, you know, duplex, triplex, fourplex are all single family. They're not being built. And that is ultimately the challenge, because the math doesn't work today, but it will create a shortage in the future. Here's where dwellings are under construction. I give investors this head up. Lots of them are going into the multifamily space. I get it, but understand that there's a lot of new development happening. So if you're buying an old building, good on you. Be very aware that you're going to be competing with new buildings as they come online. What does that mean for you if you own an old building? You better upgrade it. You better maintain it. You better make it look good, give it curb appeal, and you're going to be competing against that. So as you go into a market, and I'm saying the CMAs, the major cities, if you want to invest in multifamily, which I'm a big proponent of, I would go and look at the tertiary markets, because less of that new purpose-built rental is happening. So rentals under construction is the share of rental stock. Again, I'm hitting it. I'm really hammering this point to people. Be careful, investors. Know exactly where it's going on and what city you're in, and are you competing against a bunch of new product coming on stream. Okay, Calgary purpose-built rentals under construction. Boom. Calgary is feeling the discomfort of this right now as we speak. It will get worse. Edmonton purpose-built rentals, they're not feeling it yet. They will feel it. I am stressing to those in Edmonton to pay attention, get to those tertiary markets. And finally, as I wind down, I want to just shine a light on what is happening in British Columbia. Many are not paying attention to this. And this is what's happening with the Cowichan tribe opened up this conversation. EB opened up the Pandora's box. I use, this happened to be an article by this particular law firm that I don't know, but it was very interesting. What's happening in British Columbia is all of BC, 95% of British Columbia is on unceded land. What that means is our native land, we do land acknowledgements all of the time. We actually are saying this isn't our land. This is a land acknowledgement. Now, most thought it was just virtue signaling. You know, let's keep the natives happy, so to speak. But ultimately, there's legal weight with this. And the Cowichan tribe took on all of Richmond, went to Supreme Court. The Supreme Court judge said, you're right, that is your land. What? Holy cow. So imagine now, will this all get handled? 100%. How many years will it take? And the reason that we have to consider this is now in uncertainty, fear, uncertainty, and doubt. Many of you are experiencing this right now. You don't know what to do, so you do nothing. Well, guess what? When you start to understand that the fee simple is now on top of this thing called, oh, we have the Cowichan tribe actually owns the land. Well, that's on top of Crown land. What do the banks say? The banks go, who owns this frickin' land? I can't lend to this. So people in Richmond, for example, are in fact having trouble getting refinancing. They can't sell a property because are you going to buy a property in Richmond where you don't know if you've really got the title? Well, then the Pandora's box part of it is that it went on to Kamloops. Then it went on to Twin Peaks, a resort here in British Columbia. The day it happened, I said, this is going to be bad news, folks, because lenders pull back, municipalities freeze permits, buyers are going to exit, values stagnate or decline. No one knows ultimately where the priority is. Banks can't handle risk. They can't handle the uncertainty, or they can handle risk, but they can't handle uncertainty. And it created uncertainty about title. Lending is already hit and miss. Title insurance is tightening. Financing is stopping. And if financing stops, forced sellers get beat because buyers disappear. The risk is contagion. Well, guess what's happening right across? There's no guessing. We know what's happening right across the country. And that is that this has opened up Pandora's box. There are other native tribes that are saying, that's our land. We want it back, or we want compensation for it. That will ultimately be how this problem gets solved. It's going to be writing checks. That's ultimately it. That, of course, has the repercussions. The reason I share this with you is we can't deny it's happening. And I say that within, clarity equaling velocity, chaos creates opportunity. And when we pay attention to this is where the opportunities show up. When we lean into it, we see the opportunities, we create the opportunities. When we equip ourselves, we then can take action based on the data. There's a phrase that I'll leave you with, which is, if more information was the answer, we'd all be billionaires with six packs. It isn't information we need. It's actual executable intelligence and then taking action based on that intelligence. So I'll leave you with this, just some kind of final thoughts that I want to share with you. The real estate investing game has changed, likely forever, but at least for a very long time. Invest in real estate today for yield more than appreciation. It's going back to old school thoughts. Appreciation will be a bonus. Treat it like a business. Create a thesis, create a plan, execute on that plan, manage the plan, pay attention to the economic fundamentals. Treat it like a business. I can't stress it, and create a plan. Okay, the future is uncertain, but the devaluation and decoupling of our dollars are absolutely certain. We must put our capital to work. We must put our capital to work. We must own hard assets. Real estate is a hard asset that you're going to still want to own. Responsible leverage in real estate works to create long-term wealth. Be proactive, not reactive, by looking at the data and ask for help. This is probably the most important statement I'm going to make to end this, which is put yourself in an environment to succeed. You've done that today. You're here today with a group of experts. You're here today with like-minded individuals that are trying to figure out the world together. Surround yourself with trusted experts. Don't hide out. Don't deny the problem that you have. Don't be reactive. Be proactive. If you think you've got a problem coming, maybe you're dealing with it today, but you need to sit down and have a real conversation. The environment that you're putting in yourself today extends. Hanging out with like-minded individuals gives you a different perspective. My goal here today was to give you a different perspective, was to equip you with a way to look at the world through a different lens, to look at the headlines, to unpack the crap. And I'll leave you with one other thought just to point it out. The report that came out from Canada, 54,000 jobs got created. The masses will believe that and they'll go, cool. Oh, this is so awesome. Our economy is great. And then they get laid off and they don't understand why. 54,000 part-time jobs. We lost 9,500 full-time jobs. It's all to say this. Governments, doesn't matter what party, governments are always going to paint a picture to make them look good and to give you the confidence to do something. Your job is to look underneath the hood, to get to the truth so that you're making great decisions. That's what wealthy investors do. They don't buy emotion, they buy into the data and they make decisions from there. And I know I've gone a little bit over and I apologize for taking too long, but back to you, gentlemen.
Patrick,
It's great, Patrick.
you never need to apologize to us, my friend. The data and the information you brought to us, I know, because I've been reading the chat, and some people put it to everyone, and some people just send a message to the hosts and the panelists, and so you'll take a look at that afterwards as well. How appreciative everyone is for all the data that you brought, everyone. So I personally, obviously, want to thank you. There's one or two things that I'm hoping that you can kind of help me look underneath the hood, so to speak, as you said. Number one, I know when you said writing checks, the government. I have a funny feeling that's going to be me, you, Simeon, and everyone else in the chat group here and everyone else who attended the group. That's who's going to be writing those checks at some point, because it never really comes directly from them.
And because we want to really just equip people with thought process, every time you hear government, every single time you hear government is paying for something, or every time somebody says, well, the government needs to pay for this. I get it, but just always be real. Well, the government is us. The government generates no revenue.
That's
They
right.
are an operating cost. As a business, I go, they're the biggest operating cost because of the taxes, but government is us. And so every time you say government should pay for it, just know that that's us.
Yeah, I think it was Ronald. I think it was Ronald Reagan who said it the best, right? The worst 9 words in the English vocabulary is that we're here from the government and we're here to help you. Right? Exactly. I'm not sure if that was the exact 9 words, but it was something similar to that. The one thing I wanted you to help me unpack was you said solve problems, and as business owners, it completely resonates with me and makes sense, right? It's if as a business owner you want a business that is sustainable, find ways that you can help people solve problems, and you'll be the go-to guy or the go-to gal. How does that relate to real estate, though? And I've heard you unpack this in the past. How do currently people possibly look at solving other people's problems?
Right. So this goes through the education that you, myself, have provided for many years for people. So people are facing a lot of problems right now. There's going to be job losses, and at any given time, somebody's going through a divorce or a death, and so somebody has a problem. The problem they've got is, I've got this piece of real estate. What am I going to do? I'm upside down. I can't make the math work. Then we look at, from those who are educated, you start to look at, okay, well, how can I solve the problem? And maybe you can't, but when we look at certain aspects and we say, well, what is the strategy we can use? Is there a possibility to do an agreement for sale? One of the biggest and best tools for, number one, entering to buy a piece of property, an agreement for sale. In Australia, they call it a wrap. Basically, it's where you're not assuming a mortgage, so don't think about it in that way. But an agreement for sale is a great strategy. I won't get into the details of an agreement for sale. It could be rent-to-own strategies if you're trying to help somebody get into the market. If you're trying to sell a property, can you be prepared to do an agreement for sale? There is sometimes I've used agreements for sale to exit real estate over the years, because it is the better way to do it, given that we're trying to get somebody wants the property, they maybe are a sophisticated investor who no longer qualifies for a mortgage. Well, they can actually do an agreement for sale and take advantage of the mortgage that I have. So that would be one strategy. Raising capital, joint venture partners. We understand all this language. The masses, the general consumer, does not. So I find, oh, I got this problem. I'm upside down. I got to move. I got to get out of this. I look at the deal and I go, you know something? I can raise some capital. So I can go to a joint venture partner and go, hey, here's this deal. It actually makes sense. It actually cash flows. We can make it make work. We need to come up with X amount of dollars. So those are just a couple of strategies. The point is that we look at the problem, we tap into the resources we have, the knowledge we have, and say, how can we help this person solve the problem? I use, joint ventures or agreements for sale as a couple of examples. Those are pretty common. Most of us on this call would understand that language.
I love it. Thank you so much, Patrick. I mean, Simeon, I know you've been chomping at the bit to go over so much from the perspective of like what's happening on boots to the ground. And I know Patrick also from a macro level spoke about what's happening in the rental market. And for me, as an investor, first and foremost, and obviously being a real estate broker as well, I like to know what's happening in the rental market because that also then tells me what is their demand.
Well, that is our business.
Housing,
our
right?
business is the rental market.
So why don't you take that over right now?
Sure.
And for everyone who's watching, please make sure to stay. Where I'm going to go over how you're going to get access to the deck that Patrick went over, all the notes that Simeon's going to be speaking about as well. So go ahead, Simeon.
Yeah. So first and foremost, hello everybody, and thank you for choosing to be with us this morning. It's amazing to have you all here, especially over 300 people have come in and out, and there's another 700 people waiting for the recording. Further to Patrick's note, in what we call hard assets, this is the time to really try to dive in and understand that. For all the people that I know are here that are already investors in real estate, congratulations, because it's the only asset class other than precious metals that can actually carry you through these uncertain times. And what I'm going to speak to from coast to coast is months of inventory, average rent, and vacancy. These are three metrics. And again, to Patrick's point, real estate is regional. I'm going to go on a high level of the markets across the country. But if you were to take these three data points, and apply them to a neighborhood, forget part of a city, three streets, if you were to take how many months of inventory are inside that pocket, what the average rents are, and how many of them are empty, you can understand very quickly exactly if it's the right market to invest in. Now, I'm going to take you through a national tour very quickly because I do want to press and maybe ask Patrick a few more questions from his deck that I found extremely valuable, that I want everybody here to take that value as well. So I'm going to start quickly going west to east. I'm going to start with Vancouver and the GVA. Their months of inventory are getting more balanced. We do have elevated listings, of course, in all metropolitan areas. And the average rent in Vancouver and the GVA for a two-bed is about $2,300 to $2,500, depending on the submarket. Vacancy is still very tight in Vancouver. We're talking about 2% to 3% is what's reported by the board there, the real estate board, which is in sync with exactly, like it's further ahead than any other report you'll find because it's real time. What does this mean? This is a defensive, it's an anchor market. Appreciation is now highly selective. You cannot just blindly buy real estate and pray it's going to go up. That 20-year cycle of Canadian real estate doing that in metropolitan areas is for certain over. Full stop. Immigration's changed. All the drivers that were driving that action are no longer there. And dive in your own time for all those drivers. But they don't exist anymore. They're different. So you cannot just do that because you're going to get hurt. Calgary and Edmonton. We're talking about balanced markets. They're soft. They're about 3.5 months of inventory. Calgary specifically is 3.5 months. Edmonton is just under 4 months. So these markets they were buyers markets for sure a few months ago. They're getting a little bit more balanced now as we go into the winter, and we're going to see where the spring takes us. But these are markets that a lot of purpose-built rental went for. Everybody was going down that CMHC route, building 8 plexes, 14 plexes. There's tens of thousands of units coming to market. And to Patrick's point, if you have older real estate, why would I ever take an older piece of real estate if I can rent for the same amount of money something brand new? You got to stay competitive. You got to pay attention. So that Calgary and Edmonton market, do not believe for a second that you can just go there and everything will be hunky-dory. It's not. There are energy cycles. It's very cyclical. Work with absolute experts if you choose to work in Alberta, because a lot of people have made a lot of money in Alberta. A lot of people have lost a truckload of money in Alberta. So be very, very cautious. Like, for example, Patrick, you are from Edmonton. I lived in Central Alberta in Red Deer. I know that market inside out because my family did 25 years there. We just do, but other people don't. And I've seen so much money fly there blindly, and those people got hurt. So it's very, very, very cautious. Talking about the prairies now, Saskatchewan, in Manitoba, Saskatoon, sub 3 months. So these markets really don't get affected by Toronto, Vancouver. They're very, very stable markets. So if you are a patient investor, these markets may be right for you. And we can consult and connect you with teams in those provinces that can actually break down those markets and explain how those work, because we're talking about 3 months of inventory across Saskatoon, Regina. Winnipeg is even less, of just about 2.5 months of inventory. But the rents are $1,100. So if you're from Toronto, and you can't even fathom how a 2-bedroom can be $1,100, but that's what the market is. The properties cost $250,000 or $400,000, not $900,000, and they actually carry in cash flow better than anything in this city, for example, right now. So make sure you understand the fundamentals of each market and how they act and react. But the bottom line is Alberta to Manitoba, they remain Canada's best cash flow to entry price ratio markets. And those are very, very interesting for people that have patient money that are looking for long, slow, and steady growth. Always have and always will perform that way. Toronto and GTA, I mean, this is where my entire portfolio is. And this is kind of the segment that I do want, Patrick, if this is where I'm going to take you after. I want to remind everyone that real estate always has, currently still performs, and will perform as the most safe and stable asset you can have. And no matter the storm that we're in right now, the value of my real estate will be tied to the inflationary pressures of this economy. Whether we get devalued and my house now will be worth $4 million, doesn't matter. It's what somebody's willing to pay for it. But value in real estate and in gold is tied to my purchase price. The only people that are reeling right now are people who bought in the last couple of years, because they bought at that top before everything started getting hammered. So Vancouver and Toronto, the truth of the matter is the home that I'm in right now that I bought for 800 something thousand 12 years ago, it's not worth 800,000 anymore, guys. It's worth 2, whatever the case may be. And that's everyone who owns property. Depending on when you bought it, what cycle you were in, how you're financed, all these things. And when we have these assets, and I take a look at the rental market right now, months of inventory, 3.5 to 5 months, depending where in the GTA. That is a lot of inventory. That is a lot of people sitting because nobody can pay 800,000 right now when the interest, when the economy is doing what it's doing, when their job certainty isn't there. That's why the big metropolitan markets are very, very similar. So is there opportunity in chaos? To Patrick's point, there's never been more opportunity. But capital is scarce to find right now. So those who do have dry powder can take advantage of things that you could never dream of a few years back. Structures and things. Moving to Ottawa, 3.5 to 4 months of inventory. Our capital is a balanced market. Vacancy 2.6, average rent $1,900. Safe, good market. Ottawa is great right now. 2, the slow, patient, stable, fundamentally sound investor. No speculation. There is no room for that. Atlantic provinces, again, use caution. Atlantic provinces took a major driver in capital for purpose-built rental. Halifax has tons of new inventory. 4 months of inventory, 2 beds are around 1650 to 1750. Vacancy is still pretty tight at 2.5%. Affordable housing is zero. You can't even touch it. Like, there's so much demand for it. But these markets that I go from, from Vancouver all the way to Halifax and Newfoundland, there is tremendous opportunity in real estate in today's market. But you have to be so careful, so selective, and surround yourself with people who understand these dynamics and can put these opportunities in front of you to look at. Jazzy?
Well, Patrick, I mean, any thoughts, any comments on what Simeon went kind of through? I know you were nodding
A
your
couple
head and
things,
shaking your head, and so I'd love to get your 2 cents on it.
Yeah, I mean, there's a couple things around it, which is we look at the market where it is today, and we just at our last REIN meeting we had a guest speaker, a friend of ours, Carla Brown, out of Regina, and I didn't even know this. I've always been a fan of Saskatchewan, but because of the smaller population, there was not a lot of appreciation in that market. She was sharing with us that in Saskatoon right now, you can buy a bungalow, like a classic 1,200 square foot, 1,000 square foot bungalow for 350 grand. You can rent it out, unsuited, and cash flow. So you start to see where the opportunities are. My point is this, is what Simeon just shared is with the current status of the market, and we have to pay attention to that. What I shared is saying, okay, this is where the market is today. How do I determine where it's going? And I want everybody to, there is the fundamentals that drive an economy: gross domestic product, GDP, jobs. Please pay attention to jobs in your market because our tenants need to be working. Okay, so jobs is really, really important, and of course, population. So those are some of the economic fundamentals. So that when we look into the future, we assess a country, we assess a province, we assess a city, and we go, oh gosh, because, and I'm going to tell you something that, I'm based primarily out of Abbotsford, although I consider myself bi-provincial. Abbotsford 10 years ago, like, you couldn't do business in the city of Abbotsford. Population of 150,000, you couldn't do business. 10 years later, under the right leadership, the right mayor, totally changed this city around. So there's all sorts of things that we look into the future and we say, oh gosh, where do we want to do? Do we want to invest in, gold after it hits $6,000? By the way, some are, and I would even say, yeah, you might be okay doing that right now, given where things are going. But it was way more fun knowing that I started investing in gold and silver back in 2008 because I could see the future. Our job as investors is to see the future and to look at the data, then verify the data. Simeon just shared a bunch of it with us. And then we decide what we want to do with our capital. But to Simeon's point, I can't stress enough, we need to own hard assets. If you've got money sitting in the bank and you got dry powder, great. Look for ways to get it to work because it is melting as we speak. My opening slide.
Yeah, Simeon, there's something that you also mentioned too that I think we can elaborate on for another minute or so, which is the importance of reminding everyone, and even myself, I have to remind myself, you have a lot of real estate that you've invested into pre-2020 and 2022, right? I think with the ability that we have in our organization, we get to speak to hundreds, if not thousands, of homeowners, people who are thinking about maybe buying their first property, investors who have bought in that time period of 2020 to 2022. And that's where a lot of the pain and suffering is happening in our portfolios, us included.
Of course.
But when I look back into my portfolio of the properties that I purchased pre that time, I mean, you kind of mentioned it in your example in your principal residence, but we also have income properties that, yeah, we might have even refinanced and now they're maybe even, not as positive cash flow as they were in the past, but it's really that time frame from the properties that were bought in 2020 to 2022 that people are going through some pain and suffering with. And so I think we all, again, including myself, just forget what this hard asset of real estate has done for so many people. And what I love about our nation, the REC nation, I can speak about it intimately because we've been doing it for 21 years now, is that it's not made up of institutionalized investors. They're not like in some ivory tower in downtown Toronto or Vancouver. It's regular Joes and Janes that bought properties.
It's me and you, bro. It's me and you, Jas. It's
Well,
everyone.
100%. I mean, I'm a son of a taxi driver and a factory worker. You're the son of a pizza makers. You know what I mean? And so we made and created our wealth really truly through real estate.
100%.
I mean, yes, we've sold we've brokered a lot of deals, and yes, we get paid a fee for that. But that's really short-lived. By the time Simeon spends half of my money anyway, some way, somehow, with access to my credit card, I mean, I look at the end of the month and it's gone. It's the real estate that really has created the wealth.
Simeon's worse than the government.
Making a living is one thing.
100%.
Making a living is one thing. Creating wealth is another. And by no means have we reached what our goals are, because we have pretty aggressive goals in real estate, and I think we will reach those goals in the next 15-20 years, just being honest. We're working steadfast on it, but our goals are real estate related because it is the only way that our hard work can be transferred down the family tree and all the different things that it provides, right? But
can I put insert a couple of comments here if I can, and that is a couple things, and I'm going to go back to what I left you with. I'm going to encourage everybody who's listening is that if you got a challenge, reach out for help. Create a thesis, whatever that thesis. If you have a challenge, you go, what am I going to do? Well, put together a thesis that then you say, okay, well, based on that, what I believe based today, possibilities and probabilities, I'm going to put a plan together. I'll give you an example of that. So Edmonton, I have my view of Edmonton. I'm born and raised in that city. I have a business in that city. I have staff. I got family. I love Edmonton. I don't like what they're doing right now. I had a lot of real estate in Edmonton. I had a lot of real estate in Alberta, literally hundreds of doors. Since 2019, I've started to exit. Now, why did I exit? I looked at the potential upside and I go, well, yeah, there's probably still some upside, but I don't necessarily, I think the downside is greater than the potential upside, given what Edmonton is doing. We have 15-minute city, and I've talked about this many, many times within our REIN community because I do this every month. But I looked at the 15-minute city concept and I went, no, I don't like it. I don't like what they're doing and I don't like their agenda behind it. So that's a different conversation. My point is I started to exit. Now I did that for a lot of reasons. It served me in a lot of ways. I've got businesses. I wanted to make sure I was liquid as we went through the pandemic, as I saw what was unfolding in the economy. I wanted to have cash reserves, but I also wanted to have cash reserves because I knew that we would get to this point right now where opportunities are going to start to present themselves. And I want to be as liquid as I can possibly be. Number one, to make sure that, you look at the real estate investment network. This business has been around 30 years. Don't think for a minute we didn't get hammered. I don't have a problem sharing that. I got hammered. All of a sudden, everybody who thought they wanted to be an investor goes, nope, I'm out. Now, the community that remains is a very strong, committed community, and I love it. And at this point, listen, I'm 67 years old. I do what I love to do. And do I want REIN to ever go away? No. Will I continue to do what I love to do? 100%. And I've got other businesses and I got other things going on. But the point of that is that I put a plan together and I based it on some decisions and a thesis that I created, and I'm moving forward with it. Oh, yeah. I'm going to encourage you to do that. But I did that, and I'm sharing with you, I did that because I have relationships with guys like Simeon, like Jas, like mortgage brokers, like legal counsels. And so I can't stress enough, do not go this alone. Put yourself in the right environment and hang out with the right people, and you will do exceptionally well.
And just to that, Patrick, and to everybody on this call, for the last 19 years that Jas and I, in January, it's going to be 20 years that we're together working as partners.
Don't remind me.
Why? Why? You tell me you love me every day. Relax.
You're the second man I never needed, my friend.
All right. To everybody here, for the last 20 years, and may our mentor rest in peace, who taught us everything we know, and set up what it means to be valuable to people. That's how he taught us to build our business. Unless you give people value, you will get nothing. And it couldn't be more true, because we built a very significant business out of helping people. And now what I mean by that is, when we get together with our clients, and we can't help everyone, like somebody in Vancouver is going to work with somebody in Vancouver, and we are happy to introduce you to great people that we know and trust there. But in Toronto, for example, where our actual practice is, where I would be helping you, the point of this is, you have problems, and that's why we don't say, put your problem in the chat. These are personal circumstances. Everybody has their own bag. Everybody has their own circumstance. I have 3 units. I have none. I want to get into the market. Whatever your situation is, the way we've always done this thing is by analyzing and creating clarity, by creating an actual picture of you. This is who you are. Is this true? Yes. Is this where you want to go? Yes. So that clarity, that call, that appointment creates a real estate action plan, your real estate action plan. And that can only come through that time that you're going to spend with whatever professional you choose to spend it with. Should we be so lucky to work with you? Should Patrick or John or Maria in Vancouver, whoever you work with, that's what needs to happen. You need to sit in front of someone who understands, who can take your issues and figure out the best possible scenario, whether it's an accountant you need, a lawyer, whatever your bag entails. That's how she's done. And that's how we've done it this entire time. Kazi?
Well, look, I mean, what yourself and Patrick shared now for the last 90 minutes, the macro picture that Patrick shared, and then you kind of going boots on the ground. I mean, very, very valuable, but here's the truth. And I love these guys, but the truth of the matter is, and none of that really matters unless it's applied to your specific situation. If you're watching this right now, like your timing, your equity, your goals, your financing, like what does it actually mean for you today? Because see, most people leave a session like this and they're just unsure, like, what does this all mean? And as I mentioned earlier, we get to talk to hundreds, if not thousands of people every single month, and the same questions keep coming up. Do I buy now? Do I wait? Do I keep renting? Do I have an investment property? Should I just hold on? Is the value going to go up? And should I hold on? Should I keep going with the buy and hold? Should I sell my investment property? What's happening with interest rates? Like, we hear it all. The truth of the matter is, and I would be lying to you and anyone who says to you that there's one answer that can fit everyone, run away from them. Run away from them. Because at the end of the day, there's really only the answer for you. And we can only do that with speaking to you one-on-one, because Joe's situation is going to be different than Jane's. And maybe Joe should be holding on, but Jane should be selling, or vice versa. Right? I mean, there's properties within our portfolio that we have different strategies with. We can't cover that in a webinar for hundreds of people all at once. It would take us for days to answer everyone's questions. And as Simeon and I think both Patrick mentioned as well, they're very personal questions. And so we've set aside this coming week, okay, 20 to 25 minute, what we call clarity calls. You've been hearing that word a lot. And we didn't do it on purpose. It's just that we know that people have a lot of situations, problems, obstacles, whatever word you want to use. And we want to try to help you find a solution. We can't guarantee you that we can give you a solution every single time, but we want to hear what your problem, obstacle, concern is.
What if we can?
Right, and maybe we can. But to do that, we need to set up a time. And so in the chat group right now, you'll see a link. It's reccanada.com/truth. reccanada.com/truth. There's no pressure, no commitments, just clarity. If you want to help kind of unwind all these stats that Patrick went over, the stats that Simeon went over, and what do they actually truly mean for you, give us the 20 to 25 minutes. You just go to that page, you'll see a calendar, and just pick a time that works best for you. So one of our team, myself, Simeon, can get on a call with you and go over your specific situation and help possibly provide you with solutions. As I mentioned, we can't promise that we can give a solution to everyone, but at least we can hear out what your situation is. And again, no commitments, no pressure, just clarity. Like, I don't want you to leave this type of webinar with unanswered questions.
Yeah.
So go to reccanada.com/truth. Take the 37 seconds it takes to pick a day and time, and we'll make sure that we get all your
and
questions
everyone
answered.
is going to get Patrick's deck. Everybody is going to get access to Patrick should you believe that you have something for him that he could help you with. Like, this isn't gatekeeping or anything. And just so everybody understands kind of where this is coming from, the last year, hundreds of clients who worked with the REC over the last 2-3 years, all those people are hurting. It has nothing to do with them or with us. It has to do with the timing of their market. Our clients from 2010, 2015, 2018 are singing praise. But our clients from a couple of years ago are like, Simeon, this is what's going on with me. What can I do? How can you help? This is where the idea for this webinar came from. This is like the people who are sitting cushy on real estate from 15 years ago don't need any help or don't care about the truth and the new truth in real estate. They're good. The people who do care are the people who are either reeling or thinking of how to get into the market, because the Canadian market is now becoming a renter's market. Prices have not come down enough. And as investors, those who do own real estate are going to win for a very long time. New construction is not being built. In 3 years, when the slump of inventory is gone, you're going to see a pendulum go from one extreme right back to the other. And that's not healthy either. Is it good for real estate agents like myself? Sure. But it's not a good thing for the economy, for the consumer, for anyone. You want balance. You want stability. And this is what we're aiming and hoping to get people's portfolios into fundamental real estate growth and stability, not reactionary investing, emotional investing, as Patrick called it earlier. Patrick, your closing words, my brother.
You know, I love what you said, Simeon. And I will say this, over the past 25 years, you know, I've got, you know, I don't sell real estate. I literally educate people on economic fundamentals and strategies to buy real estate. I'm in the business of education and supporting people. Over 25 years, we have literally worked with directly, one-on-one, one-on-many, thousands, literally thousands of real estate investors. And I will only encourage you to say this, is that the most sophisticated investors pay attention to what's going on economically. But the other thing that I want to hit on is when we go through these times and things happen in life, in business. You know, I've been very, very successful in business, but I got to tell you, I've lost a lot of money. I've made a lot of mistakes. I've got hit many times. But the good news is I've had more wins than losses. It is a fact of business. It's a fact of life. It's a fact of investing in real estate. The point is, the largest mistake I've seen made is when investors get in trouble, they try and go it alone. They may be too much pride, or they're feeling a little bit of shame. Oh gosh, I screwed up. I must be stupid. They don't reach out for help. Reach out for help. Simeon, Jas, myself, we've been through this stuff before. It happens. And so don't try and go it alone if you've got some problems. Or if you've got some dry powder and you say, I want to make sure I do it the right way, then have a conversation. Bounce the ideas off others in the industry that have been where you want to go or where you are, and you will be far, far more successful doing that.
Patrick said that we've been there before, and we're there right now too.
Yeah, yeah, we are.
Like, it's just the truth, guys, right? It's why we made this webinar the new truth about real estate, because we want everyone to know we're not sitting on some high horses and not going through the same situation that we're hearing from our clients. And so many people, I go to a cocktail party. We were, you know, fortunate enough yesterday, shameless plug, to take the #1 team award out of, you know, all of Royal LePage signature. And so we're very grateful for our team for that. But we're meeting new people at this event, and they're all asking, like, hey man, like, when's the market going to change, and when's it going to get better, and what do you think about the market? And my question, my answer to people always is the same. Are you asking from like a buyer's perspective? Are you asking from a seller's perspective? Are you asking from an investor's perspective? Because the answer is different. It's
I
different
typically
for
just swear and walk away.
yeah. Yeah. We get it in the bathroom. We get it all over the place, man. But guys, look, we love real estate. We love helping people. I hope people kind of got that vibe from all of us today, specifically you two. You guys did majority of the heavy lifting. I just needed to come here and smile. And so thank you for that. I really appreciate that, guys. You made it very, very easy on me. Again, I keep on seeing the comments. It's amazing because they got value. I mean, for us to put this event on, we're hoping people are going to get value, but now to actually see it all kind of come together. But Patrick, from the bottom of my heart, thank you so much for getting up. I know you're up already working out.
I'm an early
I
riser.
know
I'm
you're
a
an early
5
riser.
a.m.
Yeah,
guy,
but to
so.
give energy the way that you gave it for the last 2 hours, I mean, it really means so much to me and to our nation as well. And Simeon, buddy, all jokes aside, I love you. Merry Christmas to your family and to everyone. Please take the 37 seconds to go to reccanada.com/truth. We'll set up a call that's best for you guys. We'll chit chat for 20 to 25 minutes to see if we can possibly help whatever situation you're going through. To everyone, have the best Saturday ever.
Later, guys.
Thanks, everybody.